1,900. That's the broader market forecast from Citigroup's chief U.S. strategist Tobias Lefkovich. But for the past 6 years, returns on small caps have beaten those of large caps, even with a lot of people saying they wouldn't. Take a look at this chart comparing the Russell 2000, that's the small cap index, and the S&P 500. Russell's the yellow line, people. Come on, you can see that it's really been an amazing time. But is it still really a small world after all? Where should you be putting your money now? In the large cap corner from Portland, Oregon, we have Robert Millen, co-manager of the Jensen portfolio. That's rated 4 stars by Morningstar. And in the small cap corner, Eric Barden, co-manager of the Texas Capital Value and Growth Fund, also rated 4 stars by Morningstar. But two completely different philosophies here. Good to see you, gentlemen.
Top of the morning to you, Liz.
3 years ago, we were hearing it's over for the small caps. Hardly. They've kept going. Robert Millen, what makes this year different? Why should I start putting my money in large caps?
I think there's at least 3 reasons, Liz. One deals with trading dynamics, the other with business fundamentals, and then lastly, just where the opportunities are. First, trading dynamics. The large caps had a great run in the late 90s, followed by a resurgence of small caps in the first half of this decade. In fact, if you look at the 3 great asset classes of stocks, bonds, and real estates, they're all at new highs with the exceptions of large cap stocks. Business fundamentals of many large companies have been very strong during this period when their market prices have been lagging. And then lastly, it's simply where the opportunities are, and that is in the global economy. And larger companies in the future will have the opportunity to use their financial and marketing muscle to take advantage of those global opportunities.
Eric, state the small cap case.
Well, we think small caps are poised to continue to outperform because what we're looking at are very low interest rates and very low quality spreads. That takes away one of the major advantages of being a blue chip stock. So with financing readily available, there's no more efficient entity in the world in terms of translating financing into earnings growth than a small cap company.
You say financing, I'm looking at short-term interest rates that play into the picture. I mean, higher rates squeezing smaller companies who maybe find it a little too expensive to borrow now, Eric?
Well, we're actually seeing rates that are fairly low in historic terms, but what's more important is how easy it is for small caps to get borrowing relative to large cap companies. What's more important there is actually the quality spreads, the difference between junk bonds and higher quality bonds. And what we're seeing today is those quality spreads are very low. So essentially, it doesn't really pay today to have a very high credit rating. It's just as easy to borrow if you're a little bit more of a speculative company as it is if you're an established blue chip company.
Robert, I'm starting to go with Eric. Change my mind.
Well, if you look at the fact that many of these large companies have been growing their earnings by 10–12% a year during the past 5 years, when they've had stock prices that have either been flat or only modest growth in the low single-digit rate.
Tell me about it. Microsoft, General Electric, everybody's waiting.
Absolutely. But, you know, in the long term, the business fundamentals always drive the market. And so that correction of the disconnect that's been going on is likely to happen. And the longer that disconnect goes, the sooner the correction's going to happen. And I think when you throw on top of that this opportunity in developing economies like Brazil, Russia, India, and China, it's the large companies that have the marketing and the financial muscle to help build their infrastructure, to grow their global brands, and to take advantage of growth that's going to be much faster in those economies than in the U.S. economy over the next 5 years. People
were saying that last year and the year before, though, Robert, and nothing happened.
And one of the great virtues of being a long-term investor is patience. And these were the times in the last 2 or 3 years to buy these great companies and then enjoy the rewards that one will get, in our opinion, over the next 5 years.
But suffer in the short term. Eric, are small caps overpriced right now? You're telling me that a 6-year-long bull run, the bulls aren't starting to get a little gray around the horns there?
Well, we do agree that large caps are probably more attractively valued today than they were in 1999, but the small cap rally is occurring off of an unprecedented discount to large cap valuations. The rally over the last 6 years that we've seen has really only brought small cap valuations in line with their historic averages.
When does the small cap run end?
I think it's really
play devil's advocate here.
Once you start seeing those quality spreads increase, when you start seeing developed markets outperform emerging market economies, when quality and treasuries outperform junk bonds, that's the type of environment where the psychology is not as constructive for small cap stocks. I don't think we're seeing that today, and where valuations are for small caps being at parity with the large cap averages, it's really about the earnings growth today. And the earnings growth story, again, I think favors the small cap stock simply due to how easy it is for small caps to get financing today.
Okay. People want to know your favorite names. Robert, you start. What are your best picks here?
Well, I'm going to start with your parent company, which is General Electric. This is one of the world's great companies. Their earnings are up 70% in the last 5 years, and yet the stock is down 30%. That's a huge disconnect, and if you think about their opportunities globally to help build the infrastructure in China and India and elsewhere, I think the opportunities for GE to continue their strong growth in earnings and then be followed by a strong growth in its stock price are pretty compelling right now.
Do you have a second name?
I do, and that's Procter & Gamble. Procter & Gamble has 22 brands that are $1 billion or greater in sales with their acquisition of Gillette, and we think that their opportunity to take those global brands and spread them across the world, and frankly the synergies that will come from the Gillette acquisition are not built into the market price yet.
Okay, so those are two big mega caps. Eric, take a shot. Your two favorites.
Well, I'd offer a golf club manufacturing company called Aldila. This is a company that trades at roughly 12 times earnings, but it's experiencing explosive earnings growth over the last few years. Even though the stock has doubled, we actually think there's still quite a bit more upside to it. Also, I would suggest Celadon, which is a trucking company that is one of the only trucking companies licensed to operate in both Mexico and the United States. So as cross-border traffic due to NAFTA continues to increase, Celadon should primarily be the beneficiary of that.
Good to see you both. We appreciate your time. The big versus the small. Robert Millen with Jensen Investments and Eric Barden with Texas Capital Value and Growth. Mark.
All right.